like to look at traded options. Let's just write the name down here. What are they? Well, they are a financial instrument whose value is derived by an underlying financial asset. So they are an example of derivatives because their value is based on the value of an underlying asset. And they give investors some flexibility in being able to profit from markets that move in one direction or markets that move in the other direction. So you can profit from a market that's going up, you can profit from a market that's going down. You can also profit from a market that isn't really moving at all. And you do that by combining various different types of options. We will look at strategies later on, but what to do is just look at the basics of traded options. So let's have a look at the basics. 1. The sort of textbook definition of a traded option is a financial instrument that gives you the right, but not the obligation, to buy something within a specified time frame at a certain price. Let me just explain that a little bit. Think about if you were, let's move away from the stock market for a moment. If you were a farmer, or if you bought, if you bought regularly from a farmer, and the farmer said to you, well, you don't know what the price of wheat is going to be in 3 months' time, but if you pay me £100 now for a quantity of wheat, I will let you have that quantity of wheat at a specified price that we agree today, any time during the next 3 months. So you're given an option. You're buying an option on the underlying asset, and I guess that's why they're called options. You have the option to buy it if you want to at a pre-agreed price within a certain time frame. So that gives us two very important concepts. An option always has something called a strike price. And that is the price that, in our analogy, you agreed with the farmer that you would pay for the goods if you decided to go ahead and buy them. And the other thing is they have an expiry date. They don't last forever. In fact, they don't really last for very long at all, and different options have different durations. So an option then is a financial instrument that gives you the right but not the obligation to buy something at a predetermined, pre-agreed price. Now, options are an exchange. Certainly traded options are, not all options are, some are over the counter, but most options that you are likely to come into contact with are traded over or through an exchange, which is why they're called traded options. And that exchange removes the need for you to have to negotiate independently with the farmer, like in our analogy. You just buy them on an exchange and the rules are already set in place. So you have various options when buying options. One, you can buy a call option. Now, a call option is an option that gives you the right to buy a certain quantity of underlying shares at a pre-arranged, pre-agreed price. You can also have a put option. And a put option allows you, it means that you enter into an agreement to sell a certain asset or certain share at a price, at a pre-agreed price within a certain time frame. So a call essentially allows you to go long of the market, and a put allows you to go short. Not always the case if you start combining calls and puts and writing options as well, but we'll come on to that in subsequent videos. So you can either buy a call option or you can buy a put option. So let's assume that you think the market is going to go up. So let's go back to our favourite stock, ABC PLC. Now, there aren't just options available on stocks, they're available on a whole host of financial markets, but the basics are pretty much the same. You think ABC is going to go up. So what do? You buy a call option because you think it's going to go up. Now, the call option will have two important factors. It will have a strike price, which is the price that you are willing to agree to pay for the underlying asset. So let's assume that ABC is trading at £1. You will have the choice of buying a whole range of options that give you the opportunity to buy the underlying asset at, say, 80 or 90 or 100 or 110. Now, obviously, the price of the underlying asset is 100. So if you're buying a call option, so if you're buying the right to buy the stock at, let's say, 80, the option is already worth 20 because you're buying the right to buy it at 80, the underlying stock at 80. So if you were to do that, you would instantly have a 20-point profit. And that extra profit will be reflected in the cost of the option. You'll pay more for an option that gives you the right to buy at 80 when the underlying stock's at 100 than you would to, say, buy the right to buy the stock at 110 when the stock is trading at 100. Why would you want to buy a stock? Why would you want to pay 110 for a stock that's trading at 100? Well, you might think that the stock's going to go up. You don't pay so much for the option to buy it at 110, and then if the price rises to, let's say, 130, all of a sudden the intrinsic value, which is the difference between your option strike price and the price of the underlying asset, that's the intrinsic value. There are other factors that affect the value of the option, but the intrinsic value is less if the stock is trading at 100 and you're buying the right to buy it at 110, than the intrinsic value if you are buying the right to buy the underlying asset at 80 when it's actually at 100. You're buying the right to buy it at a discount here, you're buying the right to buy it at a premium here. So there is no intrinsic value in terms of the strike price by buying this option, but there is intrinsic value here. And the difference between the strike prices, between buying the strike price of 110 and the strike price of 80, is it will be reflected in the cost of the option. That is one aspect which will affect the pricing of the option. So the strike price will affect the pricing of the option. And in this video we will just look at call options. In the next video or subsequent videos we'll look at put options. It's exactly the same, but it's just in reverse. We're looking at a call option. The underlying asset is trading at 100. We are going to buy a contract, one contract, options are split into contract, and the contract will give you the right to buy a certain number of the underlying asset. It depends on the market. Sometimes it's 1,000, sometimes it's 100. And we now need to think about when do we want it to expire. If we go for a 3-month expiry, we will pay less than if we were to go for a 6-month expiry. And that is down to the time value. If you buy an option that has 6 months life left in it, then there is a greater chance that the price will move in your favour, and that is called time value, and that is reflected in the cost of the option contract. So the longer the time to expiry, then the longer then the more you pay. And if your option was going to expire tomorrow, the option would settle pretty close to its intrinsic value. So if you had the right to buy a share at 120 and the share was trading at 100 and the expiry was tomorrow, the option is pretty much worthless. If expiry is tomorrow and you've got the right to buy the stock at 100 and it's trading at 120, then the option is worth 20. I hope that makes sense. What we've said is, when buying options, because you can also sell options, which is called writing them, which isn't just like selling a share, it's a bit like underwriting an insurance policy. And we'll come on to that. And you can use the writing of options in various different combinations to create different spreads that you might want to benefit from different types of market moves. But all will become clear in later videos. But for now, we are looking at buying call options. That means we think the market is going to go up. The two important things we need to consider are the strike price. At what price does the option allow us to buy the underlying asset? That is very important. If you were buying an option on a house, if you had the option to buy that house for, say, £100,000, and the house was actually worth £300,000, then you would have a valuable option. If you had the right to buy that house at £500,000, and the value of the house was £300,000, then that option wouldn't be very valuable at all. So strike price is key in gauging the value of the option. And the other thing is the time value. Are you buying an option which expires tomorrow, in which case, let me just write time value, in which case the time value is almost negligible. Or are you buying an option that expires in a year's time? And there are long options that you can get, particularly in the US market. They're called leaps. Are you buying an option that expires in a year's time? In which case, the time value is likely to be a very significant aspect of the pricing. And you might think, well, let's buy options that are, have a long time until their expiry. But the value of the time element of the price of the option gradually decreases as the time goes by. So you might or might not want to do that. It all depends on your strategy. Anyway, that's options in a short summary. I hope that makes sense. We've looked at call options. We will look at put options, which, as I said before, are exactly the same, but they are in reverse, so they give you the right to sell. But everything else about them is exactly the same. And by combining call and put options, and we'll look also at writing options, then you can put together strategies that will profit from just about any market condition. But of course you have to predict that market condition, and your prediction has to come right. Options are also very risky because you can lose all your money. If you buy a contract of options and it expires worthless, then you've put everything that you put into that option contract will disappear, vanish, and go to money heaven. So, well, actually, it doesn't. It goes to the other person in the other side of the deal. So you need to be very careful before you think about trading options, and I'm in no way recommending that you do so. But if you are interested, then this is a tutorial that hopefully will help start you on your way and show you how options can work. That's all for now. I'll be back another time with some more.